age, I think.
Yeah.
Excellent. Patrick Francie, Kyle Green, welcome, guys. Welcome.
Hey,
Jengi, how you doing,
You know, I just realized, like, just as I'm pressing the live button, that I've been making the cardinal mistake for like the last forever. And I've just been assuming people know who I am, right? I never introduce myself. I just start talking, right? So for everyone listening, my name is JG. I'm the Chief Growth Officer for REIN. And thank you for watching. And that over there is Patrick Francie. He's got the lumberjack look today, CEO of REIN Canada. I like that. Down in the trenches, Patrick. I love it.
No, it's not lumberjack look. It's just checkered. Lumberjack would be red and black, by the way.
Yeah, exactly.
This is a very cool, very stylish shirt.
Oh, I have no doubt, Patrick. I have no doubt.
Okay.
Patrick, I know that. Why don't you take a minute and introduce our guest here today? Because I'm really excited. We're going to be talking about the one thing that stops most investors: money. We're going to talk about that today. Patrick, who's our guest?
Our guest today is Kyle Green with the Green Mortgage Team. Now, Kyle is a top-performing broker based out of Western Canada. Home is British Columbia in Vancouver, but he is licensed as well in Alberta, and I think in Ontario now as well, or on his way to doing that. But he is a top-performing broker, as in the top 1% of 1% of performing mortgage brokers in Canada, which is really pretty amazing given how, well, he looks young. He is actually relatively young. To me, everybody seems young. But, and so today with Kyle, what Kyle brings to the team in terms of our strategic alliance and relationship with Kyle is a lot of experience in getting investors lined up with mortgages. And more importantly, he's truly an in-behind-the-scenes guy because he's getting he's getting mortgages for real estate investors. He himself is a real estate investor. So he's in the trenches himself in terms of real estate investing, but more importantly, he adds a lot of background in terms of what's going on in the market that you won't see in the headlines, you won't see it, in a report. This is in the trenches working with real estate investors from single family to multifamily to every other strategy and tactic that you need to get financing on. Kyle and his team are the guys that are doing it. So that's Kyle Green.
Wow, Kyle, that was a hell of an intro, brother. I mean, that's a big intro. Now, Kyle, you're kind of known behind the circles. I don't know if you know this or not. You probably do, but you're known behind the circles as like the team that gets the deals done. And I like that about you, and I think that's awesome. Tell us about sort of financing in terms of market conditions right now. If I would say, and Patrick, I think you'd agree, and you'll have your own opinion of it, but especially in the last 2 to 3 years since the mortgage stress test, I mean, it has just put a serious vice grip on the potential of the REIN community. People are just, in a tough spot in terms of getting their deals financed. Where are we at now, Kyle? Give us a bit of a play-by-play here.
Yeah. I mean, the reality is since 2008, financing has become tighter and tighter and tighter every single year. And that trend hasn't really changed. We have seen things at least settle down, though. So the stress test came out a couple of years ago. Things are very, very tight. And since then, it's been about as tough as it is today as it was a few years ago. One small change we did see, though, was a lender in the spring came out with a new net worth program that allows investors who have a large amount of liquid assets to use that to supplement their ability to qualify for residential financing. Not just for owner-occupied, which is typically the case for these net worth programs, but also if you're buying rental properties.
So can you tell me what that looks like a little bit? Can you give me in a scenario what that might look like? Yeah,
so you have to have at least $250,000 in liquid net worth. And what the lender will do is if you only qualify based on your income for, let's say, a $500,000 mortgage, but you have another $500,000 in liquid assets, they'll take that $500,000 and add it to your borrowing power. So now you would be able to qualify for up to $1 million in lending. So they're basically using your net worth to top it up, because in theory, you could use that liquid net worth to pay down the mortgage down to a level where your income would be able to service it. So it's a very unique program, especially for real estate investors that are finding it's challenging. One other key too with the program is that it's not just for residences and rentals, but also they go up to 80% financing under the program if you fit certain parameters or guidelines, where a lot of these net worth programs are usually capped at 65% financing.
Well, that's good. Those are the kinds of programs that can really make a difference. And you might not be able, 'cause I don't know, my feeling on it is you might not be able to get another 10 properties under this program, but you will be able to squeeze another deal or two, or maybe three out of a lender like that. Is that pretty accurate?
Yeah, for the most part. I mean, most banks do have a cap or limit on the number of properties you can have in total and the number of mortgages you can have with them too. In general, most investors find that they're going to reach a bit of a wall when they hit 5 properties in total. That's where a lot of lenders say, you know what, we won't finance you anymore. There are a few lenders that will go up to 10 properties in total, as long as you don't have more than 5 with them. So you can't go to the same bank and accumulate 10 properties and get financing through the same bank. You really do have to spread it out. And frankly, when dealing with a mortgage broker, you're going to find that the best lender for you today is going to be different than the lender that was the best for you last year. You know, a few years ago, we were jamming a ton of stuff through CIBC. They had a really bad audit with the government, and they had to shut down a bunch of programs, and they're really, really rigid. And now very little of our business goes to CIBC, and now we're diverting it to different lenders. So it's just it's a very fluid industry.
Yeah, I could speak to the CIBC conundrum firsthand.
Yeah. Oh yeah, we're throwing everything at CIBC. It's like, oh, another deal that sticks, right? And today they're very, very rigid. And I was actually talking to our CIBC connection, and last year when things started to go down the toilet a little bit, not down the toilet, but getting tighter, their volumes were down 50%.
Wow, that's big. Yeah. That's billions of dollars. Now, Patrick, a question for you, because listen, you've been doing this since the 90s. And, it sounds so far away. That's why I say it like that, right?
Okay, late 90s.
And Kyle, you've been at this since 2006. But my interpretation, part of this for me, is that these lending conditions, these lending rules, it's an ebb and flow. You're constantly moving in and out of different lenders. You're playing the game. I mean, this is just one big game that you have to constantly play. Has it ever been different, Patrick? You've been at this since the 80s.
Since the 80s.
Well, I bought my personal residence in the 80s, so I think there's a couple of things that I want to take away from all of this. Is number one, yes, it's changing. There's always something there. Things come in cycles. There's economic conditions. There are black swan events. There's all sorts of things that affect what the banks do or don't do. First and foremost, that we have to realize that that's always going to be happening. Secondly, what I want to shine a light on is that when you have somebody like Kyle on your team and REIN on your team, REIN's built around creating the education, but also being the resource and the source for information, education, as well as connections with somebody like the Green team. Now, what that all means is that whether you're just starting out or you've already got an existing portfolio, to really stay on top of what changes are happening within the banking environment, you need to work with an investor-focused mortgage broker. Now, I know Kyle and his team, they provide mortgages for end users, but they have a huge focus on working with investors. So that means that they're constantly looking at strategies, looking at ways, creating relationships with the bank, understanding what the banks are doing so that they can, in fact, get funding for their investors. Now, for those individuals who are just starting out, and this may be a little bit long-winded, but for individuals who are just starting out, understand that a mortgage broker only gets paid if they get a deal done. So it's in Kyle's best interest to make sure that he's staying clear and concise and current, so that he can look after you and get that deal done and get you the financing that you need. Incredibly important to have the right person on your team to achieve that kind of result. And given what, and knowing what's happened over the past 30 years in banking doesn't change, the past 20, the past 10, to Kyle's point, since 2008, changed the world. I mean, ultimately, what happens is that it does take somebody that's focused to stay current and understand it. And the other thing that I want to point out here, JG, and given what we've done recently at the member meetings where Jennifer Hunt laid out, what does it take really to have financial security, to have financial certainty, to have financial freedom by design? How many properties does it really take? Kyle's talking about 10, and I mean, if you can get 10, you're in the sweet spot. We had a great presentation with Jared, who points out 8 in 25. How do you take 8 properties or 25? No, what was it? 8 and 25. Now I've lost the context for it.
Yeah, it's eight properties, right? And it not take you 25 years
right,
to get
8 and 25. So in other words, getting those 8 properties paid off in half the time. And it was really, what it really spoke to was the success that you have investing in real estate, but you need to get mortgages. So that's where Kyle comes in and can support you in achieving those goals.
So, yeah. So Kyle, question for you, which is, you've been at this since 2006. Do you is this the environment that's going to be like forever? Do you ever see it loosening again? Are we ever going back to 2005, 2006, or should we just permanently change our expectations here?
It's interesting. I mean, history has it tends to repeat itself, right? And already down in the U.S., we're starting to see that lending is starting to loosen up. It's frankly a little bit concerning how quickly they're already loosening up, considering that we're only 10 years removed from the large financial crisis that caused this whole issue. That being said, I think the Canadian government just wanted to be conservative with their approach on how lending guidelines are dealt with. I do think that we will loosen up, and we will loosen up in probably a couple of years, but I don't think we're going to get back to the good old days where, for instance, with TD, we used to say 35% down, no questions asked, and the deal was done, essentially. We used to have a lot of other scenarios, too, where you could state that you're earning $200,000 a year, write that down on a piece of paper back in pre-subprime crisis days, and the bank would say, oh, you are self-employed, and the number is reasonable, and they approve your deal. I don't see those coming back. So I think that we will see a loosening of certain guidelines and certain criteria, but I don't think it's going to get back to where it was, 10 years ago. So financing is harder, and it just requires a larger level of commitment to a game plan. So you have to get in there, and you got to figure out, where do you want to be in 5 or 10 years? Where are you at now? And how do we bridge that gap and ensure that you have a structure and a game plan that will work for you? So you don't just go in, buy a property, go to your bank, and they say, yep, no problem, we'll approve you for this one, and come back when you've got another one, and you come back with the next one, and then they say, oh, actually, you don't qualify. And maybe the reason you don't is because you didn't set up the first one in the ideal way to have longevity with being able to build the real estate portfolio.
I think, Patrick, you'd agree we're seeing a lot of those mistakes. People come to REIN because, like Patrick said, we're the source and the resource. People come to REIN and say, oh man, you mean there's actually a way of setting up your portfolio? I shouldn't have just went with my banker that my mom introduced me to when I was 13. Definitely not. There's a specific way to go about it. Now, do we think, though, gentlemen, there's an argument to be made that this tougher lending is actually creating a smoother, longer-term growth curve here to our real estate portfolios, so that it's not going to go up and come crashing down. There's a lot of people, and Patrick, you know a lot of them, that were in their heyday in the early 2000s up to 2007, 2008 in Alberta that got a ton of real estate, and they've been hating themselves ever since because it hasn't quite recovered, because it's gone up and down and up and down. So my point is that my question is, are these tougher conditions creating a smoother, longer term growth curve for our real estate market as investors? Is this a good thing, is my question.
Well, if I was to pass opinion on it, I would say it is a good thing. Back in those years when it was easy to get a mortgage in Alberta, you could assume a mortgage. A lot of oversights in terms of what people were buying. And I always say, when the market's great, when the market is thriving like Alberta can get, unemployment at 4%, and everybody's working and everybody's making money, and there's a shortage of units, everybody's a real estate investing genius. We're all geniuses. Mm-hmm. And then all of a sudden, oil and gas, crap hits the fan, the yogurt hits the fan, everything comes off the rail. All of a sudden, vacancy increases, jobs, unemployment increases, rents come down, you can't rent your place, and then everybody who invested in real estate is an idiot. But that's not true. Everybody who invested in real estate without the right education, without the right foundation of learning, because in every real estate market, there is opportunity, and there's lots of opportunity right now in Alberta. What changes in any market is strategy and tactics. So back your question, is getting financed, I believe it is, because it actually weeds out a lot of individuals who are just doing it easy and mess up the market. It makes people more thoughtful. It really drives the need for education. We know that real estate is an absolute way to create a financial future, a financially certain future, and when it's done right, when it is based on education, when it's based on economic fundamentals, when it's based on understanding what tactics, what strategies to use, and as importantly, when it's based on understanding what you're committing to in the world of mortgages, for example. And I've just recently have spoke to more than a couple of people that have really made some big mistakes when they started investing in real estate when times were good. They even refinanced, which was the next part of the problem. And I can tell you that my partners and I have made lots of mistakes that we've paid for. We continue on putting in the correction, but it's because of guys like the Green team in the mortgage world that we start to also understand what do we need to do to put that plan together. And that's all part of one of the foundational parts of REIN's education is treat your real estate investing like a business. Treat it like a business.
Yeah.
You'll start to understand how to succeed.
What are your thoughts, Kyle?
Yeah, I agree with you, JG, that when you have these restrictions, it prevents the market from ramping up too quickly and then having a large correction. So yes, it's harder to acquire the assets, but it does protect the value of assets that you already own and that you will be owning in the future. I think that it allows for smoother curves. I don't think that we're going to see as many of those runs where we're seeing 10, 20, 30% increases over a short period of time. I think you'll see this a little bit more stable, a little bit of a slower growth, but it will be very steady. And I also think that we won't be seeing massive decreases with valuations either. So I do think that it allows for smoother growth curves up and downwards.
Well, I think that's very important. It's important for the investors that are in the market now to understand that, and the investors that want to get in the market to understand that, because a little harder to get in, but once you're in, smoother growth and perhaps longer term growth. Now,
yeah,
let's talk about rates, because this is a hot topic. I mean, we could do a whole seminar on where rates are going and your thoughts on them and what that means. So let's start there. Where do you think rates are going?
Yeah, I mean, what we've been seeing over the last 9 months is that bond rates have actually dropped significantly. So whenever you see bond yields increasing or falling, you can expect fixed rate mortgages to actually follow. There's about a 98% correlation. So what happens is, long story short, banks lend out money to you and me, they bundle up the mortgages, securitize and sell them out the back door, and international investors can buy either bonds or they can buy what are called mortgage-backed securities. So they're almost the same asset class, same risk, and that's why they're so closely tied together. So what we've seen in the fixed rate side of things is that bond rates have fallen considerably. It primarily is tied to the U.S. tariff situation and some international guidelines that have been pushing a lot more people into a more volatile position internationally. Now, that being said, the Bank of Canada has yet to be making any moves. It seems like most economists are predicting that there may be a decrease to the Bank of Canada rate sometime this year, which means that anybody in a variable rate would be seeing about a 0.25% drop this year. And most economists are predicting about a 0.25% to 0.5% drop for next year. So we could be seeing up to a 0.75% decrease on anybody with a variable rate by the end of next year. It really depends on what happens down in the U.S. What Canada really wants to do is whenever the world economy slow down, they want to make sure that they're still pushing out their exports. We're a very commodity-based marketplace here. Yep. If people are all of a sudden not buying commodities, say, for instance, China's not buying as much of our product, we need to make sure that we are keeping our prices low in Canada. And one of the ways of doing that is by actually reducing rates. Back in 2015, we saw Canada actually take some action to do that. When oil prices started to go down, we actually aggressively lowered the prime rate here in order to keep our dollar low, which puts our goods on sale. So we may be seeing a similar situation, particularly if some of the markets that would typically be buying our commodities start to slow down. There'll be a lot of incentive for us to drop our interest rates. Interesting.
So you think, if anything, interest rates are flat to going down in terms of where things are going. So what I find very fascinating is that even though it's a little tougher, it is tougher to get the financing. I mean, this money is very cheap money. This is just about free money, Patrick. I mean, this is a good time to be a real estate investor.
Yeah, especially for somebody that owned it in the 80s, right, Patrick?
Okay, you guys, quit it. I want to expand on that. I want to expand on one thing. At the recent meetings, Jennifer Hunt, our vice president of research, pointed out that, and I know this, I'm just not coming up right now. When we talk about interest rates, there are a couple of countries that are actually talking about paying people to get a mortgage and to borrow money. So interest rates, given what's going on in a global economy, the pundits are very, very much predicting that rates are not going to go anywhere for a very, very, very long time, and there's a strong chance that they will actually continue to come down even more. Now, we won't ever get to a point in Canada where we're paying people to borrow money, but having said that, that's all, when we look at what drives mortgage rates and bond rate, all of those things, there's still a global economy that's impacting that. And when we look at an economy in a global scale, there's two things. We look at it as investors and go, wow, that's almost free money. Of course, when you look at somebody like me who's a boomer or perhaps a millennial on the other end of the scale, you got two different issues. You got boomers who can't take, where do they invest their capital? Because if I put my money in the bank, then I'm getting no return. As a matter of fact, I'm losing money. If I put $100,000 or $1 million or whatever the number is in a bank account, guess what? I'm actually losing money by doing that because there's no interest. So where do I invest my money? In a stock market, which is like, who knows what's going to happen with the stock market? There's no way to leverage your capital, number one. And number two, if it crashes, or I can lose a lot of my principal in a heartbeat, right? And literally a heartbeat, given what goes on digitally. On the second side of that is millennials. There's mortgage rates that are low, but how do they get into the market with a down payment and step up to actually play the game and be able to engage in owning real estate? So this environment, when you understand it, is creating huge opportunities. Now, we talk about, this whole Facebook is really about REIN, and it's about the events that we've got coming up in Edmonton, the Authentic Canadian Real Estate Systems Program, the Acre event that we're having at the end of this month. But really, that's primarily what drives the learning that we have. And when we look at a picture called real estate investing, that's what we're looking at.
Mm.
Yeah, it's fascinating. But you said something interesting there about the opportunity. See, when our guests come to Acre, they learn about, and this is, I've talked to so many real estate investors that are, I don't know, they don't know, they're uneducated, they're unaware of the opportunities in the marketplace. You just pointed something interesting out, Patrick, which is you got boomers who typically are in a place where they have loads of capital and no place to deploy it safely. Don't want to necessarily work there. You got millennials who need capital to deploy into real estate, want to get into the game. So there's an opportunity to put those two people together there and really create some magic. And that's the kind of thing that can happen at Acre at the Real Estate Investor Summit, because you're surrounded with like-minded individuals. Who knows, Patrick Francie may even cut you a check to invest in.
Who knows?
So I'm super pumped for you to be there, Kyle. I am super pumped to see you on stage, to spend more time with you. I'm fascinated by what's coming in this market, because anytime the market moves, there's major opportunities that are presented. I think that there's some huge opportunities out west right now, specifically in Alberta. And I just think that in general, even though it's a little tougher to get in the game, or a lot tougher, I mean, I think that there's more and more opportunity. I think Patrick is right that the fact that it's difficult to get in blocks a lot of the bad stuff from also getting in, creating a better market for us. So, Kyle, what I love about you is not only are you one of the top brokers in Canada, not only have you done $750 million of deals, but you're an investor yourself. And there's so many mortgage brokers out there who like to finance either consumer deals, residential deals, but they're not investors themselves. What do you say, Kyle? And now take off your mortgage broker hat for a second and put on the investor hat for a second. what do you say to a real estate investor who's sitting there on the fence thinking, should I go to this event? Should I go meet this Kyle guy? I mean, he's got great hair. What an awesome tie. But, should I take the time? What do you say someone who's been investing like you since 2006?
I mean, almost every presentation that I do, I talk about the returns in real estate and how they can outpace almost every other type of investment you could be doing. You make money in 3 ways when you invest in real estate: from the cash flow, mortgage pay down, and appreciation. And the thing that I like to highlight is that, number one, when you buy real estate, you get leverage. If you get an 80% mortgage, then that means that for every 1% of appreciation, your return on investment is 5%. So just from the appreciation aspect, we assume about a 3% annual appreciation. Your return on your investment is 15% just by owning real estate. On top of that too, generally speaking, you're trying to find something that cash flows, a little bit of a return from cash flow, maybe between 1% and 4% cash flow going into your jeans. But most importantly, let's say that you bought something where the tenant just paid your mortgage for you, and let's say that there's no appreciation at all in your real estate, which would be a little crazy, but let's assume that. Just having the tenant pay down your mortgage for you is between a 7.5% to 9% return on your money per year.
Wow.
Just from having the tenant pay down your mortgage.
Wow, that's
it's crazy. And I asked the audience, so who here is getting more than 7.5% to 9% consistently in their stock portfolio? The stat is 1 in 50 people put up their hand.
Yeah. And so what you're talking about, I just added it up real quick. I'm not real fast on the numbers, but 1 to 4% in cash flow, plus 7 to 9% on the pay down, plus 15% on the appreciation. You're looking at anywhere from 11 to 26%.
Yep.
So, I mean, and I would say that that's consistent with what I've also seen. Very, very well explained and very succinctly. So perfect. So if you're interested in 26% ROI annually, then you should come up to ACRE.
Yeah, exactly. Learn how to do it.
Learn how to do it. Get to ACRE. One of the things that as we wind this up, we've been at it 27 years. REIN's been at this 27 years. I've myself been over 50 acres that I've either been part of or hosted. Gigi, you've now been to a few. Like you've been to.
I've been to over a dozen now for sure.
Yeah, a dozen acre events, and so this many years into it, there is a system, there is a process, there is support. There is a way to be successful investing in real estate when you're supported. And so that's what I got to say about that. Everybody should be getting out to ACRE in Edmonton. And
tickets are going super quick. So Kyle, look forward to seeing you there. Patrick, pleasure as always. Thanks for wearing that lumberjack shirt. That was great. And Kyle, you're awesome. I can't wait to spend time with you, pal. Thanks for doing this. Thanks, guys.
Thanks a lot.